Welcome from Omaha Airport to our after Berkshire Hathaway meeting talk with Stephen Wood and Fred Liu. Welcome.
Thank you. Yeah,
Nice to be here. Stephen, you asked a question at the shareholders meeting of Warren Buffett and Charlie Munger and Berkshire Hathaway. What was the question and how satisfied are you with the answer?
No one's ever satisfied with the answer because they go into template mode, template talk mode. But the question is basically, it was a leading question. I'm writing a book, and Buffett has generously given a full letter back of feedback. And it was a follow-up question, which is basically, I wanted to know the motivation and also the motivation that he has. Clearly, he doesn't think of him, or he. There was another question actually quite a bit better than mine about deferred gratification. Clearly, Warren is not doing this for the money. I mean, while he has a NetJets membership, he's not spending any of it. He's not living that lifestyle, right? It's all. I think that Buffett is his primary motivation. It seems obvious to me with Berkshire's investments. He's just building something that can just continuously compound. So, and the idea came for me after looking at Vanderbilt. When Vanderbilt died, on the inflation-adjusted, total wealth creators of all time, he was like maybe 13th. But 10 years later, his son just basically kept everything intact. It had compounded to the point to where he was then second, right? And so it seemed very apparent to me that Buffett is basically trying to build something that can just continuously compound for quite a long time, where basically in 100 years, Buffett's in the top 5 on the league table, if not maybe even close to the top. I mean, he has quite a ways to go to get there. And so I basically asked him what was his primary motivation, and how do you build a compound machine that can actually adapt so that it can continue to compound. And then I said, is this your primary motivation when you wake up every day? And the best part of the answer was, he said, it is the only reason why I wake up. So in some respects, he validated it. And then they basically just talked about how the compounding is going to be lower than a lot of other companies. And they sort of watered down expectations, which is smart, right? But Buffett has to keep his public persona in line with the folksy Nebraska person that he is in some respects, but he also is a fairly, one of my favorite Buffett quotes is intensity is the price of excellence. And he is fairly intense, and he has an intense focus. But he just, and so I was leading a question to try to get him to talk about that myopic focus on like this big compounding machine. And so he delivered in some respects, and he didn't in other respects. So,
Fred, what questions do you have to add to the Berkshire Hathaway meetings, and what were your takeaways?
In terms of takeaways, what Stephen was saying, I think it's interesting that Buffett has kind of changed his tune on the tech investments. Over the last few years, he's talked about how they kind of miss Google, how they truly respect Bezos. And it seems like for the first time this year, they've almost capitulated in a bit.
Well, they've always shown an ability to adapt. They're always adapting, and that's right. How does adaptation outlive Munger and Buffett?
Yes.
In this organization, that was part of the reason why I asked that question, right?
Mm-hmm. Exactly.
They hated airlines. Now they're Now they're the largest airline investor in the world, right? So, and no, they're adapting. Yeah. You could say capitulation, but they're also adapting.
Yeah. Adapting is probably a better term for it.
Yeah.
But in investing, the world is constantly changing, right? And especially with new business models and different populations kind of entering this, call it the global economy, you have to adapt the way that you think about businesses. And it's actually really great to see them kind of admit that and say, hey, we grew up in an era where maybe our frame of reference or mental models aren't so attuned to the tech universe. Yeah. But, it doesn't mean that it's the wrong way to invest. Yeah. And I thought that was fantastic.
Well, and how many 95-year-olds actually have you ever seen adapting, right?
Yeah.
So you just keep it.
Sure.
Go ahead.
You are invested in China, and Chinese people were you saw them all over the meeting. And
yes.
There's a huge Chinese community. going to Omaha every year.
Yeah.
What would be, in your eyes, an interesting Chinese investment for Charlie and Warren?
So they like extremely stable businesses, and I think, Charlie obviously has a large exposure to Himalaya Capital and Li Lu's fund, and they're well known for their multi-investment, right? If I remember right, they bought it at a low double-digit PE ratio many, many years ago, and that company has continued. I mean, Multi is one of the best brands in China. The bottles regularly priced at 2,000 RMB, right? It's considered a very nice business gift and kind of a luxury gift. And if you want to talk pricing power, there's almost no better brand in the world. And so maybe it's not a new investment because Munger obviously has exposure to that, but I think that fits right within their wheelhouse.
And Steven, you're more focused on Europe. What would be interesting for them in Europe?
I mean, I've already written Buffett about this. So in thank you to all of the feedback that he gave me on the book, I basically was like, here's my favorite European idea. It's Rolls-Royce. And actually, literally the question before I asked mine was about, like, would you look at UK investments? And he's like, we're ready to deploy quite a bit of capital into the UK. Rolls-Royce is in the and the great thing about, back to the stability of their businesses, Rolls-Royce is at the beginning of a multi-decade ramp in free cash flow, and it's not economically cyclical, or it's not very cyclical at all, right? But it's the product cycle that they're in. 40% of their products have just come out of their deepest negative cash flow parts of their cycle, and they're all flipping the opposite direction. So free cash flow is in the process of going from around, I think this year they're saying it's going to be 700 million, but it's really going to be quite like almost $1 billion. And that's on the way to go to like 2.5 to potentially even 3 billion over the next like 3-4 years. And there's almost nothing you can do to stop it. And from that back to that compound machine and like the cash generators, like Rolls would be a perfect investment for them. And there's actually synergies with Precision Castparts, which they bought. So to me, it's a no-brainer, but they haven't done anything yet, probably because right after I sent them the letter, there was some odd behavior from Rolls-Royce perspective, like that they were quite evidently trying to get the stock price up. They did some things that they've never done in the past before. And so I'm guessing if there was an approach made, then the price at which the takeout was unappealing to him, because he spent more than most, I would say. I don't know if you agree, but like he spent a long time talking about actually the Kraft Heinz error and the price that the overpaying in the price. And we're just at a point in the cycle that I don't think Uncle Warren wants to be super bearish about the economic cycle right now, but it's quite obvious that like you don't really want to be deploying a lot of cash right now, which is basically the implicit answer to all of his all of the questions that were asked about him about capital deployment. It's like he kind of likes having 100 billion lying around going into this next phase of the market cycle.
Let's go a bit away from Buffett and Munger to your approach and to your ideas. We already talked in some videos. You find them up above in the link about your approach and also about ESG and how you look for the future and interesting companies. Fred, what is your approach and how are you investing?
Sure. So I run a firm called Hayden Capital. We're highly concentrated. We have really about 7 positions at this point. Extremely low turnover strategy at about 15% a year. So we're really looking to own what I would call taxes on ecosystems, and trying to spot these kind of taxes or release valves in these industry profit pools at an early stage. And so, my process, we typically look within the TMT and internet space for these types of names. Number one, we invest globally. So within the internet space and TMT space, there's a lot of case studies that you can say, evaluate what is happening in the US. And by understanding that may give you an advantage in terms of understanding how Asia is going to develop. Or say companies like Alibaba, which owns Hema, which is the supermarket chain. If you understand that business and how they generate about 4 to 5x per square foot compared to traditional grocery stores, you can kind of understand, for instance, why Amazon bought Whole Foods. And so we look for situations like that where we can almost have that information arbitrage across geographies. And so, like I said, a lot of what we own and what's beautiful is about network effects, right? It's one of the stickiest moats out there. And so a lot of our portfolio focuses on kind of marketplace type of dynamics and evaluating, for instance, the demand side and the supply side and how those two are being built up and what the advantages are for a particular company versus their competitors.
Can you please drop some names that the viewers can get an idea what companies you're looking for?
Yeah. So one example, and actually our newest investment that was made towards the end of last year, is a company in Southeast Asia called C Limited. And what's interesting about them is that on an optical level, they look to be, they don't screen very well. They seem to be bleeding a lot of cash. It seems like Alibaba was going to eat their lunch because they have unlimited access to capital, and they own a company called Lazada, which competes within the same region. And what's interesting about them is they own a gaming division, which recently signed a right of first refusal with Tencent, which means that they basically get first look at all the games for Tencent, and Tencent is then able to monetize in China as well over the last year. And so they have to go to Southeast Asia to kind of make use of these games. And so this division, when we started looking at it, the entire company was worth about $4.5 billion. Those in Singapore look at it, it's a Singaporean company. People look at it and say, it's bleeding cash, it's unprofitable, it's like number 6 marketplace in Singapore. No one was interested there. And the thing is, this company was listed in New York, and U.S. investors don't pay attention to Southeast Asia as much either. And so the gaming division was spitting out about $400 million EBITDA, or projected to this year. They're going to do about $1.2 billion in revenues. The company was trading for $4.5 billion market cap. And what's interesting is that all of those cash flows were going into a division called Shopee. Shopee is the C2C marketplace within Southeast Asia. And last year they did about $10.2 billion in GMV. And we learned that they were just about to start monetizing. We've heard since that Lazada is starting to pull back in the market because Alibaba has kind of a profitability focus nowadays. And so you're about to see that inflection in profitability. And we were able to spot that before a lot of people in the market did. And a lot of that process involved kind of boots on the ground, right? And understanding the incentives of all the different players, talking to employees in there. Lazada changed CEOs 3 times last year. There's a reason for that. GMV was flat to down when the entire market grew 30%. Shopee grew 100%. And no one was pricing it at anything. Flipkart got bought at a $21 billion valuation for a $7.5 billion GMV. Shopee did 30% of total market share within all of Southeast Asia, and the market was valuing at 0. So those are the situations that we really love. And if it works, this is a very asset-light marketplace type of business. And everything that they're investing into is subsidies. And subsidies are great for building market share when you're coming from behind, because you can kind of bleed out your competitor. And when you reach a point where you're matched with your competitor, then you can flip that profitability switch. So, yeah.
Steven, I have the feeling that do you want to ask a question on this?
No. I'm thinking about TripAdvisor in a similar context.
What are you thinking about?
Yeah, well, there's an emerging not very similarly, but like there's an emerging opportunity that TripAdvisor has that is sort of 1 to 2% type of the way through penetration. So like in destination experiences, all happens offline. Only about a few % of the transactions are actually being booked online, and so TripAdvisor did this interesting thing where they're profit maximizing their legacy hotel business, because a few years ago they tried to actually increase conversion in their hotel business. Consumer behavior in booking in Expedia was set, and it was very hard to displace that. And so it was very expensive for them, and they were fairly unsuccessful. So now they've actually flipped, and they've done a more private equity model for their hotel space where they're profit maximizing that to invest the hell out of their in-destination restaurant and attractions businesses. They're leading competitors by 10 to 15x on a revenue or supply inventory basis. And that part of the business is growing 40%, and they're redeploying all the revenue growth into more marketing and OpEx to support that, to continue to actually pull away from the competition. So the reason why you saw the look is because I would actually prefer we probably have less stock price appreciation based on EBITDA growth, so that we can actually potentially be the monopoly on in-destination experiences. We have over 3 billion people that use our app, 500 million monthlies. And so there is, when you get to a destination and you're looking for something to do, there's almost no other place that you try unless you're just going to Google something.
Interesting. You both have investments in Europe.
Sure.
You own Ocado and you own Zooplus. Maybe let's dive a bit deeper in these two names and look what's your idea behind these ideas.
Ocado is, quite frankly, we're harvesting it right now to redeploy into more attractive opportunities, because the price has completely reflected the next 3 to 4 years of good news. That said, Ocado has completely transformed from when we entered into a grocery distribution business to now basically a logistics supplier, a logistics technology services company, who we actually, in one of our other holdings, are potentially going to be one of their customers, actually. So it's very interesting going from an investor to a customer side, potentially, in Ocado. And the beautiful thing is like they have struck some very interesting partnerships around the world to distribute or basically do grocery fulfillment for Kroger, for Casino, for some other multinational companies. But really the incremental opportunity from here is they have a 15-point operating margin advantage versus their competition in the UK, who have greater scale. So that technology that gives them that 15-point, again, this is retail, so 15 points of margin is generally 3 times a grocery's complete margin, right? The incremental opportunity for Ocado is actually taking that technology and applying it to general merchandise. And so anyone who's not Amazon and needs to sell things online probably can get the scale of Amazon, if not better technology than what Amazon currently has. And they can basically get it for a turnkey solution just to pay Ocado a fee. So Ocado can still probably triple from here, but there's quite a lot of good news baked into the stock right now. And so from a near-term perspective, I think there's probably more interesting things elsewhere, but we still own some. And literally tomorrow they could strike a deal with a very large consumer goods company, and that has the sort of multi-pound per share jet fuel of more free cash flow in 10 years' time, essentially.
Interesting.
So yeah, we've owned Zooplus for a number of years. And in recent months, what's interesting is that, so just to give a little bit of background, Zooplus is the leading online retailer for pet food within Europe. The pet food industry typically grows about, call it 2-3% a year, but the online segment is aggressively taking share at double digits per year. Currently, it's about in the high single digits market share within Europe, and Zooplus has over 50% market share within that segment. What's interesting is that of their returning customers, so customers who have been with them for longer than a year, there's extremely sticky customer base. And one of our theories at Hayden is that call it the moat or the bottleneck for a lot of industries is moving towards owning the customer instead of owning the supply. And so when you see a customer base that literally has 95% sales retention year after year, extremely sticky, that gets us extremely interested. And so Zooplus is going to do about $1.6 billion in revenue this year. 1.1 to 1.2 of that is going to come from repeat customers who they make, pet food isn't necessarily a high margin industry, but it's a highly recurring and very habitual type of purchase. And so last year they made about 3.6% on their repeat customer base. And the stock is trading cheap right now because the market is concerned, number one, about Amazon. And we've actually done surveys of customers who leave Zooplus, and less than 10% actually leave Zooplus for Amazon. The majority actually go towards Fressnap. Fressnap is trying to price match right now, but Fressnap is a brick and mortar retailer that has a franchise-franchisee model. And it's in our theory, we've never seen these types of situations work out well, where you're kind of alienating your franchisees by pricing 20% cheaper on your online channel versus brick and mortar. And so I don't think that's a sustainable position. But the market is concerned because new customer growth has been slowing down. And so they need to find different ways to acquire customers, let's say so through social media, through direct mail. Traditionally, 80% of their marketing spend has been through Google, and Google has gotten much more competitive in recent years. Their CACs have basically doubled in the last couple of years. And so over the next couple months, it's going to be a very pivotal moment for this company. They just recently hired a couple ad agencies in order to help manage their call it offline advertising. And so around Zooplus's 20th year anniversary, I think you'll see some of these initiatives roll out. Their marketing team is entirely new. Their former CMO, Chief Marketing Officer, left last year, and they brought in an entirely new team, guys from Sixth. They brought in a new head of sales and marketing analytics. They just came in November, so it's still very early days. And I think what you're going to see is kind of a call it like a recovery within that new customer growth rate. And so if you just look at repeat customers, again, that's extremely sticky business. You're making about $40 million on those customers every year. The stock is worth about 600 mil, trading at, call it less than a 0.4x sales multiple, or call it 15 times repeat customer earnings. And, Chewy just filed a S1, right? You can argue, Chewy is a bit highly valued. But what's interesting is the margin profile looks extremely similar. The only difference is that they are spending a little bit more on marketing in order to increase their revenue growth rate. But Chewy is being valued at about, rumor is about 1.2 to 1.5x sales. And again, Zooplus is trading at about 0.4. And so there's a large discrepancy there. And so if they are able to reaccelerate their new customer growth rate, so, watch Instagram, watch the customer reviews coming out in the next couple months, watch the engagement rates with this company, I think you're going to see that valuation gap close. And this company, despite maybe having stumbled in the last couple months, it's still growing about 15% year over year, having come down from 20%. So that's what we are kind of seeing with Zooplus, and that's the opportunity there.
Very interesting. Thanks. To end our interview, I just want to ask, what is your most favorite Buffett and Munger wisdom that's most unknown? Do you have one that's interesting to share?
Most unknown.
Or even most unknown?
I mean, you don't want to sort of be the kiss and tell her, but he is way more intense in reality than he comes off as. And I think that in sort of studying epic value creators of all time, they're not always everyone's best friend. And so I think that Buffett is probably, I think I see a lot of value investors try to do the Buffett way of just being everyone's friend and being everyone's nice guy, but you don't really generally get very far by just being everyone's best friend and never saying anything controversial. So that's basically, I mean, in terms of what most people miss about him is that level of intensity that that fuels me every day, essentially. So.
Yeah. Actually, to kind of piggyback on that, Buffett in his early days, so what's interesting is actually at the meeting, he made a comment about, if you are in this business, you need to understand the psychology of other people and how other people think and what they expect of you. And I think Buffett understands that extremely well. And to Steven's point about, Buffett kind of comes off with this folksy air, extremely simple demeanor, but it doesn't seem to be how he actually is when you reconcile it with comments from his early partners, old newspaper articles about him. He's definitely what I would consider a killer and very, very aggressive. Yes. The guy literally...
and I don't think that's a bad thing.
Right? No, not at all. I think in this business, because it is so competitive, you need to think about it 24/7. Yeah. And, he didn't really... spend as much time with his family because he was so dedicated to the craft. But yeah, basically, I agree with that.
And like, just to piggyback off of this, I mean, there's so many people that start a fund, including like many of the questioners that said, what would you give the advice of me trying to start my own fund? There's so many people that see the apparent public image of Buffett and say, I'm just going to sit back in my cushy chair and read for 20 hours a day. And make one decision a year. And I don't, by the way, we don't make a lot of decisions every year either, but they take a much more leisurely approach to it. And I think that, and I did that, if you can learn from my mistake, I did that a little bit too much earlier in my career, because my mentor, who was very close with Buffett actually, was encouraging me to wait for the fat pitches, and he loved the fact that I was 80% cash because I wasn't just going to deploy the cash. That was the wrong message for me to take at that time. You really have to have an unabated, intense drive to succeed, and he does have that. But I think he is also genuinely means very well and is a very good person. But what you don't see is that level of intensity, which is, I think, very important to not miss, particularly if you want to try to emulate. I wouldn't recommend anyone emulate his path, but if he's a role model for you, please pay attention to the killer in him.
Thank you very much for this great insights and this great interview.
Thanks so much.